Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Back to new highs. Well, after a brief pullback in the stock market in April, we've bounced back in May to reach new all-time highs on the major market indexes. Inflation has been a key focus of market watchers for some time now, and a cooler than expected report on the Consumer Price Index for April sent stocks rallying more than 1% to new all-time highs this past Wednesday. Now, the rise in stocks is being predicated on the fact that the Fed will ultimately cut interest rates this year, perhaps a couple of times, and lower rates are usually a catalyst for positive stock valuations. There's another side to this equation, however, which is that many of the components of inflation have been moving higher on the same expectation. So cooler inflation has driven investors to bid up things like copper and corn and housing because of the anticipation of lower rates, which actually increases the likelihood of higher inflation going forward. Round and round we go. For this week's featured insight, what's your benchmark? Most investors are aware that there are various benchmarks for performance, usually well-known market indexes like the S&P 500 or the Aggregate Bond Index. And while there is certainly a natural desire to beat the market or beat the benchmark, most investors have financial goals that aren't necessarily driven by what a particular market says they should be doing. For example, if your only goal is to beat the S&P 500 index, that means you should be very happy if you lose 20% of your money when the S&P goes down 30. But would that really make you happy? In addition, many of the market indexes like the S&P have become quite concentrated, and they don't necessarily represent a well-diversified portfolio. In fact, despite the fact that the index has 500 stocks, just 7 companies make up more than 30% of the weighting of the index. All things to keep in mind when you're deciding how you should evaluate investment performance. Looking ahead, all eyes on NVIDIA. Well, another 3 months has passed and investors are on pins and needles awaiting yet another earnings report from AI chipmaker and market darling NVIDIA. Now, the stock is already up 90% so far this year, and that's after being up more than 200% last year. Despite the fact that earnings expectations continue to rise at an unbelievable clip, NVIDIA has thus far been able to wow investors with even better than expected results on each of its past 4 earnings calls. What investors would be wise to notice, however, is that the magnitude of the increase in forward estimates has actually been falling from 100% to 50% to 25% to 20% over the past 4 quarters. Now, should that rate of growth in earnings estimates continue, or I should say the decreasing rate of growth in earnings estimates continue to slow, it could be a sign that the stock is fully priced, at least for the time being. With that being said, the company has pulled plenty of rabbits out of hats in the past, and it will be very interesting to see what they have up their sleeve this time. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.